In the last video, we built a diversified investment portfolio. But here's something that surprises many new investors. Even if you never buy another investment, your portfolio will still change. A portfolio that starts as 60% US stocks, 20% international stocks, and 20% bonds will not stay that way forever. Markets move. Some investments grow faster than others. So how do you keep your portfolio aligned with your original plan? That's exactly what we'll learn today. Imagine you invested 60% in US stocks, 20% in international stocks, 20% in bonds. 1 year later, without touching anything, your portfolio now looks like 68% US stocks, 17% international stocks, 15% bonds. Nothing went wrong. The investments simply performed differently. This gradual change is called portfolio drift. It happens naturally whenever different investments earn different returns. You originally chose your allocation for a reason. Perhaps it reflected your age, your retirement horizon, or simply the amount of market volatility you felt comfortable accepting. As your portfolio drifts, that balance slowly changes. Without realizing it, you may end up taking more or less risk than you originally intended. That's why rebalancing is important. Rebalancing is not about chasing higher returns. It's about maintaining the level of risk you deliberately chose. Suppose your US stock allocation has grown more than expected. There are two common ways to restore your target allocation. The first is to sell part of the investment that has grown the most and use those proceeds to buy the assets that now represent a smaller percentage of your portfolio. This works well, but in a taxable brokerage account, it may create capital gains taxes. The second, and often more tax-efficient approach, is simply to direct your future contributions toward the investments that have become underrepresented. Instead of selling, you buy more of what you now have too little of. Over time, your portfolio gradually returns toward its target allocation while minimizing taxable events. There is an important distinction between retirement and brokerage accounts. Inside many retirement accounts, such as 401k, 403b, or similar tax advantage plans, you can generally rebalance without creating a taxable event because the trades happen within the account. Brokerage accounts are different. Selling investments that have appreciated in value may generate capital gains taxes. That's why many investors prefer to rebalance brokerage accounts, gradually using new contributions whenever possible. Understanding this difference helps you make better decisions while keeping unnecessary taxes to a minimum. One of the most common questions is, how often should I rebalance? The answer may surprise you. There isn't a single perfect schedule. Many investors review their portfolios every 6 to 12 months, or whenever their allocation drifts by a meaningful amount. For example, around 5 percentage points from the original target. The important thing isn't choosing the perfect date. It's creating a consistent habit of reviewing your portfolio periodically. Some people think rebalancing means predicting what the market will do next. It doesn't. You're not trying to guess whether stocks will rise or fall tomorrow. You're simply returning your portfolio to the allocation you chose before emotions entered the picture. Sometimes that means buying investments that have recently underperformed. Sometimes it means reducing positions that have grown substantially. You're following your plan, not your emotions. One of the biggest misconceptions about investing is that once you've built a portfolio, you're finished. In reality, investing follows a simple cycle. Plan, invest, review, adjust, repeat. Not because markets demand constant attention, but because your financial plan deserves periodic maintenance, just like any long-term research project. Evidence Corner. Today's Evidence Corner comes from research published by Vanguard on portfolio rebalancing. Their conclusion is reassuring. The primary purpose of rebalancing is not to increase returns. It is to maintain your chosen level of portfolio risk over time. The research also found that very frequent rebalancing offered little additional benefit while increasing trading activity and transaction costs. Instead, periodically reviewing your portfolio and rebalancing only when allocations drift meaningfully from your target provides a practical balance between maintaining your desired risk level and minimizing unnecessary costs. Conclusion. Today's lesson is simple. A well-designed portfolio doesn't stay balanced forever. Markets change, your investments grow at different rates, and over time, your allocation naturally drifts. Rebalancing is simply the process of bringing your portfolio back in line with the plan you created. Your assignment this week: if you already have investments, write down your target allocation, then compare it with your current allocation. Has it changed? If so, don't rush to sell anything. First, identify why it changed and consider whether directing future contributions toward underrepresented investments could gradually restore your target allocation. If you haven't started investing yet, write down your intended asset allocation and decide how often you would like to review it once you begin investing. Having a plan before emotions enter the picture is one of the best habits you can develop. In the next video, we'll take the next practical step: how to choose between ETFs that appear to do the same job, and how to evaluate them using objective criteria such as expense ratio, index tracked, diversification, and fund size. Remember, understand the foundations. Build a simple structure. Let time do the heavy lifting,